Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Michael Romer, Managing Partner at Romer Debbas, a boutique real estate firm right here in New York City, to discuss 4 predictions for the spring real estate market. Michael, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
All right, let's talk about the first prediction. You don't think pricing is going to substantially decline for the spring?
Well, with challenging times in the real estate market across the country, first of all, hot off the press, on the Hill today, Fed Chair Powell was talking about aggressive measures needed and a so-called disinflationary process. And right now, I think we're looking at a half-point rate hike almost guaranteed in March, plus maybe 2 or 3 additional rate hikes coming our way in the near future. So here in New York, I'm a lawyer, but I feel like I'm a part-time therapist trying to talk to clients about what they should do. What I'm not, though, is a foreseer of the future. I don't have a crystal ball. But the spring, I'm holding optimism because across the country and even here in New York, we are still dealing with low inventory. So as long as the inventory is low, price declines should remain in the single digits.
And for the second prediction, everyone always asks, does this feel like 2008, 2009? Do you think there is a housing bubble here?
Well, bear in mind, we're in a much different time than 2008, 2009. That time we were dealing with a subprime lending crisis. Banks have really tightened up their procedures when it comes to approving residential loans. And it's just much different now. I'll give you an example. In 2004, when I bought my first home, I asked for a pre-approval letter and the bank asked me 3 questions: what my name was, what my fax number was, and how much I wanted. And I was approved for a 95% loan back in 2004. Thankfully, we are in a much different place and banks have tightened up their standards. So with respect to a bubble, banks are in a much better situation on the residential front. On the commercial front, I'm seeing more worry and concern because you have building owners here in metro areas that are sitting on loans. And when we're dealing with office lease issues, business issues, big picture economic problems, that I think is the real bubble.
And what about the first-time home buyers? Will they get any relief here?
First-time home buyers, what we're looking at here in New York and across the country is truly a housing affordability crisis. So the first-time home buyers that are having a hard time qualifying for a loan, as interest rates increase, it's only going to get harder because banks work with debt to income ratios. And the more expensive it is to actually borrow money from a bank, the harder it is for that first-time home buyer. Cash is king in this day and age right now, and the liquid buyers are winning out more often than not. So it is truly a crisis across the country, housing affordability. We do need more housing and we need more affordable housing.
And the final data point here, we know transaction volume has plummeted. Do you think that can make this correction live a little bit longer?
Well, bear in mind, we went through a record last few years, and Q4 2022, we really did see a major drop in transactions, almost 40%, at least here in the NYC metro area. But I know we're seeing this across the country as well. So now there is a market normalization, but what we're missing and what this market really craves is interest rate stability. And I think from what Fed Chair Powell said today on the Hill, it could be a bumpy road in 2023. We all have to hang on because real estate does remain the most safe and secure asset in the world, in my opinion.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.